Okay, this is a video about Control N. That didn't work. Control N. I'm making a new sheet. This is a video about PE ratios. Well, no, it's more. How about DCF valuation in absurdly simple in absurdly simple terms. Now, in the video I just made earlier was one for First Solar. Can you give me just a minute? I'm going to download I'm going to go to valueline.com. And then we'll download I'm going to download a couple of things. Let's go to this one. Okay, and okay. Now I'm gonna stop the video. Just let me find it. Just let me stop this. Okay, I went to First Solar, and then they have all this wonderful stuff. This is pretty good, actually. They have a history and a forecast. So they forecast the earnings per share in 2016 to bounce up. That should theoretically give you a higher stock price, and then they give you the quarterly sales, and looks all very good, doesn't it? And then you can get, this is kind of cool, you can get the history of the reports. Okay, so here's the one from July, and this one was from just a second, I can't, this one was from March of 2015. This is, for me, you can see how wrong people were in making their forecasts. That's why I kind of like that. The other thing we can do is, I think they're very old-fashioned. I used these, I think, in the 1970s. I really did. Or 80s. How about 80s? And what is this? Shit, I can't remember what the December 2014. December 2014. Okay, so I have a bunch of those reports. I kind of like that they do that now. Now, let's go back. I'm going to get this while I'm here, because I'm going to get that. Now, if you look at these, okay, what was this? Okay. Here, the price, look, the price went from 70 down to 50, and then kind of went up. And this again, the beta was still this 1.35. Now let's go and get one of these and just look at it. I hope we why March 2005, 15 July 2015. Is that? I assume that's the last one we have. Okay. And how do I get rid of this? Oh, great. I need to. Oh shit. Oh. Okay, and God, okay, I can't do it. Oh shit. If I just press this, does it get rid of it? There we go. Okay, here's what they do. They give the first thing, they give the PE ratio. Well, this PE ratio would suggest, well, we've had a bad year of earnings and we expect it to go up. But what they also do is give the relative PE ratio. So if we put this, let's put FSLRPE. And I haven't told you what I'm really doing with all this yet. 17.4, this is my problem. I don't explain things. Okay, here's what I'm doing. I'm going to explain how important the horrible cost of capital is. We're going to do a simple kind of basic PE analysis, and in the PE analysis we're going to see, well, does growth matter? Does what's growth, cost of capital, or return on capital? Now, let's try this with the entire economy first, and we're going to just kind of make a very, very simple PE analysis. I'm almost embarrassed. Or DCF. I said DCF analysis. Oh, excuse me. Okay, so we'll just measure this a couple of ways and try to assess the whole stock market. Now, the next thing they said is the relative PE ratio was 0.91. Okay, and 0.91. And okay, and this is maybe we should almost always make these things at the beginning. Okay, and then we'll put value line inputs. Okay. Okay, and then so the overall market PE is this divided by this. So right now the market has a PE of an incredible 19.12 times. What does that mean? Okay, now what we're going to do is a DCF valuation of this. Okay, now we're going to see that any kind of valuation, I don't care if it's a DE, a PE or anything, I'm value line, macro analysis, okay? And we're going to see that anything depends on the growth rate, the cost of capital, and the return above cost of capital. Okay, that's the only things that really affect the growth rate. I mean the growth rate, the valuation. Now we'll start with some crap. Let's say our base investment. Okay, and that's what we're going to use to compute the rate of return. We need a investment to get that. Let's just make that some arbitrary number. This can be 10 trillion billion zillion or something. This can be the whole economy. And then this, we have to see, well, how can we grow? Can we really grow that much faster than the economy, the stocks? Maybe they can. Maybe they can. Let's put 6%. Now, we're going to do this all in a very static analysis. Now, I can't put that. Let's put 4%. Okay, 5%. And then let's make the cost of capital, the nominal cost of capital, I don't know. Let's make it, I can't make it 5%. Let's make it 6%. I think that's too high. And then the next question is, what kind of rate of return do you earn relative to that cost of capital. Let's say you're making 4% above the cost of capital or something. All right. Now, with that, we can compute a few outputs. So our outputs are going to be the value, the total value, and then the total value relative to earnings, or the implied P/E ratio, and it's going to be ridiculously simple. You can do this with, we'll show you with an equation instead. Okay, so we've started here, and we're not quite finished. We're going to have to enter a few things. Now I'm going to make a very, very long-term analysis when we do this. Now shift spacebar, shift control plus. So let's put total return and shade this. And then we put, so our total return we're earning is, oh God, excuse me, is 10%. I should have turned it off, sorry about that. And then we need a reinvestment of earnings. Now that's just going to be, that's really 1 minus the payout ratio. So I guess we are going to put payout of earnings. Now that we don't know, but here's the formula. You probably know G equals ROE, or return, times 1 minus the return times it's called the retention ratio, 1 minus dividend payout ratio. And then you can reverse that around and put return, G over return equals 1 minus dividend payout ratio. And then finally you can say, well, dividend payout ratio equals 1 minus growth G divided by return. So our payout in this case is going to be 1 minus the growth rate divided by the total return. That's such a basic thing, but you know, everybody uses this one and not enough people use this one. Now I'm going to open the generic macros file. I hope I can find it. Okay, and then we press Control Tab, or I'm going to try that new one. No. Control F6. Control Tab or Control F6. Okay, now once we have this, we're going to make a really silly long-term analysis. Now in long-term analysis, let's put a time period. Okay, and let's put 1 OEIS, and let's put 300 years. That's all we do, and it goes all the way to 300. Thank you for showing me that. Somebody, of course, I didn't do that. And then put opening balance, and then let's add the earnings. Now the earnings are here. Okay, and then we put less dividends, and we put the dividend payout here, and then we put closing balance, and then below that we put our I call this a corkscrew, by the way, because we're going to start with a closing balance, and then the opening balance equals the last year's closing balance, and then the opening balance multiplied by the return is the earnings. Excuse me again. Shift control. Oh God, I need to. And then we multiply this by and then our closing is opening plus the earnings minus the dividends. Now we'll get our cash flow, which is the. How about we'll put PV of cash flow, and that's the value. And then we take that PV of cash divided by the earnings. Okay. Now all we have to do is select this, Shift Control R, Shift Control 1 if you'd like, and Control left arrow, and it goes all the way out. So that's just how fast you can do it. And then if you want to do the NPV, you can go up to the discount rate and look at get all the dividends. Okay. And and then we take this number and divide that by the earnings, not the dividends. That gives us a 47 times PE ratio, so that's not correct either. So I kind of put this in. And the real question is, in the long run, two things. Can you earn this? Now how about we'll press Shift Control. For all this, you can select this. This is only because the generic macros are open. And Shift Control C just does the coloring for you. Okay, and I guess we could say, okay, if you're earning 3%, it's not that sense. It's not it's not that sensitive to this one. If we put 10%, we get down to 12, and if we get a growth rate of 2%, we get too little. So it's really a function of the growth rate and the cost of capital. What rate of return do you really need? Now, if we put 7% and 3% growth rate in the long-term economy, then we can do a goal seek. We could we could make a goal seek and kind of come up with the implied cost of capital for each of these things. Now, you wouldn't have had to do this, because we know that in the DCF formula we have a dividend divided by the DCF is the NPV of dividend at the cost of capital, of course, of dividend divided by of dividends. But that we can also say is, so we say value equals dividends in period 1, I'll put 1, divided by stock price. That's the price. Dividends divided by cost of capital. God damn it. And it's cost of capital minus the growth rate. But we can substitute this dividend up here. We can put value equal DPO times earnings divided by 1 divided by K minus G. Okay, so if we want the PE ratio, we put the E over here, and we put value PE ratio equals dividend payout ratio divided by K minus G. But the dividend payout ratio, PE, the dividend payout ratio is 1 minus G over ROE, or return, or whatever, okay, divided by K minus G. That's this famous value driver formula, and it works just fine. So we could put the computed PE right here. And that's simply the 1 minus G divided by 1 minus growth divided by return divided by cost of capital minus, okay, you get exactly the same thing. Okay, and then so we don't need that whole formula. Why? I mean, this whole silly thing where we went to 300 years. Okay, but we can use either one of this to kind of explain what's happening. So the first thing to do is make a data table, really, and let's see just how sensitive this whole thing is to growth and cost of capital. So let's put 1% growth. Well, that's too low. Let's say this is nominal growth. So Alt EIS, and let's put a step value of 0.5% and go up to 6%. How's that? Okay. And Shift Control P, and then so this is the growth rate. Okay. And then just on the side of the growth rate, let's put the cost of capital. So let's put the cost of capital. How about we'll start with 4%, and then we put Alt EIS, and let's do the same thing, 0.5%, and go to 10%. And this time we put it a column, and Shift Control P, well, Control X, I'll move that up just temporarily. Okay. Excuse me. Oops. Okay, and then let's put 9 here. How about okay, and let's see what happens to the implied PE. Maybe we can so we could use this one or this one, it doesn't matter. Let's use this one for now. Shift Control right arrow, Shift Control down arrow, and go to Data and What If Analysis and Data Tables. And then for the row input cell, let's put the growth, and the column input cell, let's put the cost of capital. And then what you better do is go to the formulas and calculate the sheet. You could have done that Shift F9, but I can't do that. Shift Control right arrow, Shift Control down, Shift Control 1 or something like that, and then we get the PE ratios. And now I'm gonna let's see what kind of combinations of growth and cost of capital give us the 18.18, like this, or actually the 19.12. Okay, so now I'm gonna make a so right now the closest one to 19 is here. Actually, here's the way to do this, I think. Let's insert a couple, and let's put the match. So let's put equal match, and let's go up to this PE ratio, and I think it's going down. So here's what you have to do. I hardly ever have to do this. Put -1, which means that the fifth row, 1, 2, 3, 4, 5. So let's do this, and let's put index. Okay. We don't really need to do this, but so we get this one, and then what we can do is select this and put a well, let's do this. Okay, so when the growth rate is 2%, cost of capital is, I think that's a good way to do that. We don't really, we can then we put index, and we select this one, and you press F4, and then we get a 6% cost of capital. Shift Control P. Now this, when they did this match, I better press the F4 key on this one, and I think that's okay. And let's try this, and then we can see with different growth rates. Okay, so the implied cost of capital is 6 to, depending on how fast you think the growth rate. If you really believe the economies or the stocks can grow at 6% forever, then you'd say, well, I'm really hoping for 8% return. But this is the implied cost of capital from a simple kind of analysis. And this is nominal growth. Maybe 7% is what people are expecting. I'm surprised it's that high even. Let's say that return above the cost of capital instead of 4 is 2%. Well, let's say it's 10%. And then what we'd have to do is calculate the sheet. And then we have this. If it's only 3%, then we get a little bit lower. It's not very sensitive to that variable. Okay, it's more sensitive to the growth rate. So you can go and do all of your little CAPM stuff, but the market clearly is the overall. This is kind of the overall market return. This is the risk-free rate plus the expected market risk premium. So if people are using 2 or 3% for the risk premium, and the overall beta is 1, 6 minus 2, maybe we're getting a 3 or 4% risk premium. Okay, let's put, just let me clear that up. So let's put 4% here, calculate the sheet, and then we'll put the risk-free rate. Okay. I should have done a I do an interpolate thing. Should have done an interpolate thing here. I'm gonna come back to that one. I think I might. I wonder if we can do that. Yeah. Well, let's try that. So let's say this. Let's say the risk-free rate is 3%. Shift Control P. Okay. So then we're getting the market premium, and then we're getting that to be okay. Then we're getting in this they were getting 3 to 5.5%, I guess. The risk, if this is 2, you're getting a little bit higher market risk premium. Just let me do this. So this 20 times, this was 5. Oh, if we would have come down to the this was 19. It was closest to this one. We needed to do an interpolate. So I'm going to pause the video for a minute. Okay, I just proved to myself that I really have to work on this interpolate function. I used the lookup function, and if we could have used the interpolate with the lookup, it would have been just wonderful, because it would have gone in between here. But I'm going to do that later. I don't have time to do that right now. I've got to really fix that interpolate with that lookup. It makes it so much better. But in the meantime, what we could do is just, let's make a goal seek and put the difference between our computed number and our calculated number here. And whoops, this minus this. Okay, and let's just make this difference equal to 0 by changing the cost of capital. So, and to do that, let's start with a macro and call it goal seek, and then go to data, of course, and what if analysis goal seek. Let's set the difference to 0 by changing the cost of capital. Okay, and then we can see what happens if we change the growth rate. So now we get a cost of capital. Of course, we need to stop the macro, and I guess let's go to the developer and just put a spinner box around a couple of things. Let's just make this go from, how about we'll go from 0 to 10%. I'm going to put it here, and then if you saw the other ones, I should push it up and down, and this is 7%, and we just divide that by 100 and right click and go to assign macro and assign it to the goal seek. I wish that interpolate macro would have worked. That would have been kind of good. So we can see, okay, well, here's our cost of capital for the market if we believe different growth rates. And then we could have put another bar in this one, of course. And if you believe you're making 10% higher than the cost of capital, then you know the cost of capital is actually higher, because you're expecting to earn so much. If this is only 2%, then the economy grows at 3%. Then we get a total cost of capital of about 6.3% with this kind of PE ratio. Okay, I'm going to call this our basic PE ratio. Okay, oops, and I can't put how about no, let's put economy economy-wide cost of capital. Okay, and we better save this as a macro-enabled workbook. Okay.